Commercial real estate is absolutely on sale right now. And it's on a sale we haven't seen in 15, 20 years. And so it's a really good time to be getting in, but you got to be cautious and you got to be doing it in a very prudent way. And I think longer term, call it 5 years from now, Brandon, maybe 3, we'll see.
Hello, you're listening to Ready, Set, Go Real Estate Investing Podcast, presented by Brandon Elliott. This show will be going over all aspects of real estate investing and is intended to educate, motivate, and prepare you to take action on your first or next real estate investment. For more information, please visit BrandonElliottInvestments.com. Thank you for listening and enjoy.
Welcome back, everyone, to Ready, Set, Go Real Estate Investing Podcast. I am your host, Mr. Brandon Elliott. I'm excited to have Mark on the show today. From Oregon, is a fund management manager. You've been in the game for 20 years in real estate, focused on syndication and raising capital initially, and kind of built your own team to gather money, help out investors, and diversify the portfolio. At the end of the day, you guys have invested in properties, accumulated over 1.5 billion with a B, not those M's, but with a B in total funds and projects over the years. You got 68 million currently in active management, which is awesome. Constantly focusing on, I think, 70 plus partnerships over the years, focusing on good deals. So you got 50 to 60 active deals going on right now. If I butchered any of that, correct me. And for anybody out there that doesn't know who you are, where you're from, your background, do you mind just giving that 30,000 foot view for the listeners?
Yeah, happy to do so, Brandon. Thanks for having me on. Name's Mark Khuri, CEO of SMK Capital Management. Just to keep it short, investment fund manager. We invest predominantly in private real estate. We love a handful of real estate sectors and we stay away from a lot of others.
Yeah.
And yeah, you mentioned it, been in business formally 16 years, been a real estate investor since 2005. So eat, breathe, live it every day, love it, and don't think about much else other than my family. So That's my life.
Talk to me about family for a second.
Yeah. Got 2 kids, 8 and 9 years old.
Come on. That's a great age, dude. Is that
awesome. It's
boy,
awesome.
girl? What do you got?
In that order, yeah.
In that order. Let's go. Boy and girl. Keeping you busy. Come on.
Busy. I'm bald for a reason. No, I'm just kidding.
Amen. Let's go. Right? That's so cool. That's so cool. And then you have a lovely wife, I'm sure.
Yeah. Yes, sir. Very lovely.
That's awesome.
Yeah.
How long have you guys been together?
Gosh, I knew you were going to ask. I know I'm going to mess this up.
Oh, she's not here. Don't worry.
I know, right?
You'll see it, though.
Just over 10 years. So,
all right, we'll edit that part out and we'll make it confident 10 years sharp.
Yeah, there you go.
Yeah. Be like, look at me, honey. Look at this.
Yes. Just blurp that part out.
I knew. That's awesome. Talk to me. Why did you get started in real estate? And what were you doing before that?
Yeah, so I was a financial analyst for a number of years in corporate America. Cool. And my first nosedive into real estate was, I'll preface this. My father's been an avid real estate investor since the 1970s, since before I was born. So he was a big influence on me for many, many years. Our company, SMK, is actually his and I's initials. So we partnered up in 2010 to formally.
That's awesome. Come on.
Since retired, but we talk about business, every other day. We're on the phone.
Yeah.
So it's fun. But one of my first kind of tipping my toes in, I was sitting in my cubicle in corporate America. I was probably 24. And my cube mate sitting next to me had a pro forma up looking at a multifamily acquisition while working, of course.
While working.
He had some amazing projections. I say amazing because the numbers were really high, but didn't work out that way, unfortunately.
Yeah. Projections. The pro forma. That's always gassed up. Yeah.
And, I didn't know what I didn't know at the time. And so it was a learning lesson. But I remember that we were nose deep into his fourplex that he was about to buy and become a very active hands-on investor while working. So that was my first test. And then,
when was that? 05?
That was 03, 04, right around there.
03, 04. And you guys are looking at this. You're at work. You're like, work sucks right now. Look at this pro forma. I'm about to become a billionaire,
Exactly.
And it's just looking like, wow, this is incredible.
Totally. Yeah. the plan was to buy a bunch of them and then not have to work anymore. But I'll tell you right now, I'm still friends with him, and he's the CFO at a company. So
Yeah. Well, God
didn't
bless
work
him.
out completely.
Yeah.
Yeah,
Yeah. Things happen differently in life sometimes.
that's right.
But that's cool, man. So that was kind of the inspiration. It's awesome. Would you say your father has been a huge impact in your life for real estate and mentorship and guidance throughout the years?
Yeah, definitely. Big
That's
part of it. I mean, since we were young, he's been an investor. So I remember, gosh, I was probably 6 or 7 years old.
Yeah.
My brothers and I sitting in the family room, and he would come home with a bag full of quarters from the laundry machines at the
Yeah.
building.
Yeah.
We'd have to put them in the sleeve so you could deposit them in the bank. And so we'd sit
So
there and have to count them out and properly do it. And so, real estate's always been in our family in some way, shape, or form since I can.
Yep. What's funny is I used to have those candy machines and drink machines and stuff, and I would put them in laundry mats. And I
Nice.
would go around and I would get all those quarters like once a week, and it was just aggressive and it was so annoying. But it was like that first hustle. You get a dozen of them and
Sure.
it just starts adding up, It's awesome.
Start young.
Yeah, start young, baby. Come on. It's a great first hustle. So talk to me about you mentioned that there's things that you stay away from when investing. Talk to me about that. What do you stay away from?
Yeah, and I'll share with you a little backstory. It's not just factual, but like we've tried so many things over the last 20 years as far as investment strategies and with different sponsors and operators. And
Yep.
we've invested in over a dozen different real estate sectors, from oil and gas to short-term flips to vacant land to promissory notes to student housing to senior housing. I mean, the list goes on.
Yeah.
And we just found through our experience that really what I consider myself, Brandon, is a risk manager, right? So we're
Yep.
constantly
100%.
assessing risk and reward.
Yep.
And many deals in our space tend to have similar projected outcomes, right? From a return standpoint but most of them come with a lot more risk than where we tend to focus. And so where we tend to stay away from is where we think there's higher risk. So think about construction and development deals where there's no income being produced. You have to go build it. You got to lease it up, fill it up, and have it start producing revenue. We tend to stay away from those kinds of deals because the return doesn't, in our view, it's my opinion, doesn't typically warrant the risk that you're taking. And so that's one. Another one, hotels, motels, the transient type of overnight, inconsistent ups and downs, less ability to project occupancy.
Really? You stay away from them?
We tend to stay away. I know guys that love the hotel.
Yeah, I know people I'm talking to right now that they just love it, and that's what they focus on, those boutique hotel, motel things.
Sure.
Yeah.
And they could do very well. They are a little bit more correlated to the economy. And so we don't like those types of sectors because if things get tough, people aren't spending as much in hotels and motels. So you can see occupancy drop very quickly. And then in boom
100%.
times, they can crush it if everyone's doing well and things are going well. So it's a little too lumpy for us from a revenue cycle standpoint.
Yeah. Know your market and know your clientele, know the economy, and all you can do is predict the future, and nobody's got that crystal ball. But yeah. So your experience, right? Experience of seeing all these, investing in all these, the 20 plus years of doing this, you've been able to see what works and what doesn't, and what you want to focus on and what you prefer not to, and what's going to take a lot of time or risk. And your main job, like you said, is risk management. You're bringing in a lot of money for a lot of investors, and you need to diversify, have low risk, high reward.
That's the goal. Yeah.
Talk to me about the reward part of it.
Yeah. I mean, so as far as deals go, we're looking for return metrics, right? We want to we go through a process of vetting, underwriting, due diligence that can be quite extensive for any specific deal that we're going to allocate capital to.
Yeah.
But at the end of that process, we need to be able to say with, high conviction, Brandon, that we believe this investment has a very high likelihood of meeting or beating the projected returns.
Sure.
That's always the goal of any investment. It doesn't matter what those returns are. If it's a 10% average annual return and you're happy with that and it's meeting your goals, great, go invest in it. But what's the likelihood that you're actually going to get that? And that's
Yeah.
what a lot
It's
of
not some
individual
crazy pro
investors.
forma. Yeah.
Yeah. There's a lot of ways to manipulate projected returns. Give me a pro forma in 5 minutes, I can make the returns look better. And so
Yeah.
we watch out for that regularly. And we're trying to achieve, kind of the following ROI, right? We're usually providing our investors 3 to 7% passive income or cash flow starting in year one.
Cool.
And we want that to be increasing over the holds, usually around 5 years. It starts a little lower and it builds, and we want to see about an average cash flow of 7 to 12%. That's just from the rental income while we're holding. And then when we sell the property, I want, average annual ROI from the distribution income plus the profits, soup to nuts, usually in the low to mid teens average annual ROI is what we're achieve. And then equity multiple, 1.5 to 2.5x. So if somebody puts in 100,000, they're looking to get 150 to 250,000 total back.
Nice. Let me ask. So, I know you diversify a bunch, so I'm sure there's equity positions, maybe debt positions as well. But are a lot of the deals there's tax write-offs and incentives in that as well?
Yes to everything you just said.
Yeah, all of it. Yeah. So
That's
yes, for equity positions and so forth, and then for the debt positions, I'm sure that's not a case.
Yeah, we do invest in equity and some debt as well. And so the debt is advantageous because it's lower risk, it's in
Yep.
first position, you can take back the collateral, you can
Yep.
foreclose, and you get consistent income starting in year one. Most of the debt investments we invest in, Brandon, are providing 8 to 12% income, passive income starting in the first year.
I love it. Yeah. Yeah, I always recommend that to a lot of investors that their risk tolerance isn't as high and they're like, it's their first type of investment of like, hey, I got 25 grand. It's like, all right, let's not talk. But if you got 50 or 100,000 and you're okay with losing it, and obviously not, but calculated risk and you want more of that guaranteed stuff, then focus on the debt position and go after an asset that you're okay with taking back, and sit down with your lawyer and make sure that it's all documented and that you are fully protected.
Sure.
Talk to me. So you mentioned a moment ago that areas for, some people out there can tweak a pro forma and make it look pretty sexy pretty quick. What are certain areas where are very common to, or maybe even a surprise that you've seen in the past that it's like, man, thank God we took a look here and we really analyze the numbers because it's off or it's not thought of, it's not considered, the numbers are completely different now?
Yeah, I'll start with some of the more common ones that are a little easier for folks to solve for themselves. But
Sure.
First one would be exit cap rate. Well, what are we assuming the cap rate's going to be at the time of sale in 3, 5, 7 years, whatever it is? Is it going up from where we are today or down? If it's going up, you probably are being a bit more conservative, which is good. If it's going down, you're probably being a bit more aggressive. And the amount of that exit cap rate expansion or contraction can greatly, greatly adjust the projected returns just from that one simple assumption. Another, relatively easy one to follow is revenue assumptions and expense assumptions. And so if you start with revenue, hey, we've got, whatever, a 95% occupied apartment building. We're going to expect that we're going to raise rents just based on market trends of 5 to 7% a year. That's very aggressive, especially today. And if you change that down to 2%, it will greatly affect the outcome and returns of that investment, just that one variable alone.
Oh yeah.
Occupancy is another big one. Operating expense ratios is a big one we look at. We tend to stay away from deals that have high operating expenses, Brandon. So if you think about even just a single family home, right? If you're renting out a house and you have your regular expenses that the tenant isn't paying, that can be 70% or more of your income that's coming in the door. So
Oh yeah.
something happens to the home that you didn't foresee, boom, you're not getting any cash flow that month, right? And so it's very volatile. There's not as much margin. And so we tend to stay away from high operating expense ratio deals. Now, some of the things that a lot of people may not be looking at, we're always looking at the trailing 12 or even up to the trailing 36-month financials.
Sure.
So we want to see, how has this property been performing? And then line item by line item on the expenses, what has the seller been paying for? How much? And is there any way to consolidate? Is there any way to allow these expenses to go down and feel realistic about it?
Sure.
And we've even seen pro formas where expenses are missing. They're just not even in there, Brandon. And so
like what?
that is a blatant miss, right? I think either people are doing it on purpose to make the numbers look better, or they're just
ignorance. Yeah.
or
And
just
either
unprofessional.
or, yeah, unprofessional, not the right person. It's either they're ignorant or they're doing it with intention, which is no good.
That's right. Or
Yeah.
they just don't know their numbers in the first place, right? We
Exactly.
see like unit turn costs, payroll, insurance, all of these numbers have skyrocketed over the last several years. And so people might be projecting that they're going to go back down just to be aggressive and show more cash flow and ROI.
Yeah.
I don't know that's going to happen. You might be right, but don't project that, right? Project they're going to go up. And so,
yeah. Cool, man. Talk to me some of the learning curves over the years that you've experienced and what you wish that somebody would have taught you, or your future self can go back and tell your younger self, like, dang, don't do this, man.
Yeah, I mean, I think in the early years, I would have probably paid closer attention to and taken better care of our network, right? Investor network and contacts and people you come in contact with, spend a little more time building those relationships, right? Do a little more outreach,
Okay.
ask more questions, listen a little bit more, right? And so when you're young and aggressive, you're trying to just get investors in all the time, but maybe not paying as much attention to those you already have. And so
what about the communication with that? What I see a lot of people screw up on is like they raise capital, they do the deal, and they ghost the whole time until the end of the project. And you just pray that at the end of the project, like, you get paid, right? Without communication, it's that is not a relationship. That is no good,
Yeah. So again, we started out as a sponsor and operating partner. So every deal we did for 7 years outside of our family with other investors, we were in charge of everything from A to Z, from financing to picking the paint colors at the properties, right?
Yeah.
So communication was mandatory. It's never been a question for us.
How often? Is it every couple months? Is it monthly? And monthly gets a little aggressive because there's only so much that might be getting done. But talk to me. Some people like doing it differently.
Yeah, we always do quarterly updates and distributions. And then if there's something in between quarters that we want to share, like if we visit a property and there's some updates going on some of the repairs or renovations, whatever it might be, then we'll do something in between. But our cadence is quarterly and our investors are used to that. And again, they're passive, right? So they're not looking for updates every week, every month. It's a 5 to 10 year hold. And so that can become tiring and cumbersome for them as well. And most of our sponsors and operators today are on quarterly update cadence as well. And so that's pretty industry standard. Some folks do monthly, and that's great for us as a fund manager. We'll take as much communication as we can get and as frequently as we can get, but we're not going to provide it every month to our investors because honestly, not a lot changes in 30 days. If there's something material and something's changed, great, we'll send that update out.
Yes.
Quarterly works well, but it's also, one thing that's important with communication is making sure you're providing relevant updates and answering people's questions so they don't have to ask them, right? So
good.
A lot of sponsors and operators fall short there where we read all of these updates. And as an investor myself, I see, and I'm an analyst, so I'm going to ask a lot more questions than some others, but you want to walk away from the updates saying, gosh, I know what's going on. I'm comfortable. And Mark's got a handle on it. And that's the goal of the communication.
That's good. What are you guys doing in the future? Like, what are you looking forward to?
Yeah. I mean, as far as strategy for us, we're continuing to do the same thing we've been doing for many years with some tweaks here and there. And so asset selection and strategy as far as where we're going to place capital has fluctuated only a little bit for us in the last 10 years, maybe call it 8 years, Brandon. We focus on the sectors that we believe have lower risk and still very attractive return, that are lowly correlated or non-correlated to the economy and the stock market. And so what does that mean for us? We're continuing to invest in mobile home parks. We're continuing to invest in affordable housing, tax exempt apartments. We're continuing to invest in triple net industrial, sale leaseback, small bay, different sectors within industrial space. We like some self-storage, just being cautious. It's been overbuilt and is in lower demand lately.
Yeah.
And so you got to have a steal there for us to consider it. Those are our main asset classes. We do also invest in debt, as I mentioned as well. And so going forward, continue to do those sectors. Will we add another one? Possibly. We recently invested in iOS, or industrial outdoor storage. That is another sector that not a lot of people know about, that has been, gosh, you got 95% occupied across the country.
What is that again?
iOS, industrial outdoor storage. So think about parking lots. What's that?
Okay. Like for boats type of thing, or?
Not necessarily. It's typically what we're focusing on there is you have, an industrial space, a parking space where logistics companies, transportation companies can store their trucks. There might be an office and maybe a maintenance building, but it's usually larger acreage space for businesses to operate and store things out of. But it's outdoor. It's not usually covered, right? Like traditional storage.
Are those triple net leases type of?
They can be, yeah. A lot of them can be, which is advantageous.
Outside of that, it's pretty low maintenance, I could assume.
Very low maintenance. There's not a lot there. A lot of times you got to prep and put in some renovation dollars up front to make the space appealing for the businesses. And then you're usually signing 3 to 5 year leases, give or take, with rent escalations every year. And I mean, like one of our tenants in an investment we made is a landscape company. And so they've got, I forget how many clients they have in Florida, but they've been around for 20 years.
Yeah.
They have to put their mulch and their gravel and their plants somewhere, right? And so they are a great tenant, and they, don't need a lot of office or building space. They of course have some, but they're not operating from a customer facing standpoint out of the space. It's more for their business operations. So that's a sector that we've gotten into in the last 2 years, Brandon. Really attractive in the sense that it's kind of unknown. It's not very sexy.
Come on.
The numbers are fantastic, and the amount of private equity that is coming into this space is going up and to the right every year. And so we think about it as we're a bit early, which we like.
Yeah.
And
I love those opportunities where it's like you're not following the herd.
That's right.
You are leading in a new direction that less people are at, but the numbers are good. The pro formas are good. Like it's projected conservatively, but also fairly and very well, so that's awesome.
100%. Yeah. So that's a really interesting sector for us from a risk and reward standpoint. We're going to keep putting money in there.
Heck yeah. I like it. And nobody has a crystal ball, but talk to me about the market. You're a finance guy. You like the numbers. You like, risk management. What are you thinking about the future, the economy, the rates? Where do you think we're going?
Who the heck knows, Brandon? Honestly.
I hear you.
I can spit out all sorts of stats and numbers and trends, and I will be happy to. But I'll just say this first.
God knows.
We're in a heightened level of uncertainty. And so we follow a lot of economists. We read a ton of information on what's going on daily in the markets, in our real estate spaces, in the global economy, because everything is connected these days.
Yep.
The reality is nobody knows. I will say this.
Anything can change at any given point in all different categories that will be a domino effect everywhere else. So it's so wild.
Absolutely. As far as interest rates go, I think we've turned a corner recently for the worse, where earlier this year, before the war in Iran, we saw interest rates, like the 10-year treasury, which is closely tied to commercial real estate interest rates, was in the low 4% range. And deals were getting done. And we've since spiked back up to about 4.6. Inflation has picked back up again. Everyone's reading the headlines. They know these things.
Yeah.
And so what we were projecting, we being the industry prior to the Iran war, was that interest rates would likely see more cuts and borrowing costs would go down, which, is very helpful for new acquisitions, but it's also very helpful for the industry because more transactions get done.
Yes.
Buyers and sellers come to the table and they can actually shake hands and get a deal done. Today, we've seen a lot of deals stall. There's less
Because of that.
capital moving in and out of these opportunities. Sellers are holding and buyers are chasing, and the numbers aren't working as much. Not completely, but transactional volumes going down and deals aren't penciling as much as they used to.
So true.
New Fed chair, we'll see Kevin Warsh, how he proceeds. There's a lot of pressure from the administration to cut interest rates. He previously was against that and now potentially for it. And so we'll see what happens. There's uncertainty there. I do think we'll probably see a cut or two this year, but I would not be surprised if there aren't any. I am on the fence if rates will actually go up. There's people that think that could happen too. We tend to, I would say, manage this rate environment risk by ensuring that we have long-term fixed interest rates at our properties, fixed for 5 to 10 years.
Smart.
And we want to have positive leverage right out the gate, which means the going in cap rate, there's a big delta between the interest rate, the borrowing cost, and the going in cap rate. And so we want to see 100 to 200 basis points of spread where the going in cap rate's higher than the borrowing cost, which helps you provide positive cash flow day one on the deal. And is just a safer position to be in. And so that's my quick 30 seconds on interest rates. I can talk a lot more, but let me pause and see what questions you have, Brandon. What do you want to have?
No, it's good. Years ago when the interest rates went up, especially multifamily, a lot of people didn't invest in that insurance policy of banking on fixed rates and they did adjustables. And, betting on the market is one of those things in this type of market, this type of economy. God knows, I wouldn't be betting on it too heavy. So focused on fixed lock-in rates. Like that's, even if it's a little bit more, if you can run your numbers and the deals make sense and you can negotiate at the table, that's the biggest thing right now. Like bringing two parties to the table to actually negotiate instead of people sitting on the sidelines. So it's a difficult thing, but I'm grateful for conservative underwriters and risk management investors like yourself that are still out there, still making money in this economy and still underwriting deals and helping the mom and pops out there that want to put their money to work.
Yeah, absolutely. I'll add one more point to that. If you're looking at an opportunity, you want to try and get comfortable with the supply demand story of the asset class and the location. And so we tend to focus on opportunities where we believe there's a limited amount of supply and a growing amount of demand. Econ 101, Brandon, it comes back to that. If you can do that and it's cash flowing and you can hold on to it for long enough, now is a great time to be investing because prices have reset 20 to 40% from 2022 to 2025, give or take. So we're seeing a really opportune buying time right now, which we haven't seen since 2008 or 9 in the GFC, Great Financial Crisis. And so, commercial real estate is absolutely on sale right now. And it's on a sale we haven't seen in 15, 20 years. And so it's a really good time to be getting in, but you got to be cautious and you got to be doing it in a very prudent way. And I think longer term, call it 5 years from now, Brandon, maybe 3, we'll see. People are going to look back at, this period right now, call it 2026, 2027, and they're going to say, gosh, I wish we had bought a lot more.
Yeah, that's so good, man. I love that. For anybody that's looking to get started and put their money to work and so forth, what would you say to them for advice? And then at the end of the day, how can people get a hold of you?
Yeah, I'd say first of all, determine if you want to be active or passive. That is a really big personal question. You have to figure out what's best for you.
True.
Some people do both, which is great. if you want to be passive, you're interested in passive income investments in recession real estate sectors, like mobile home parks that we invest in, I said, go to our website. Again, our company name, SMK Capital Management. Our website is SMK Cap. Sign up to join our investor network. We'll share a lot of helpful educational information, but that's only also the best way and only way to really get access to our investment opportunities so people can start learning about where we're investing and why we're choosing the deals that we do choose to allocate capital to.
Come on. That's awesome. Well, I appreciate you for being on today. Wealth of knowledge, it's incredible to see what you guys have gone through and overcome and what you guys are doing now. And it's just the beginning, man. So I'm excited for the next 20 years.
Yeah, my pleasure, Brandon. Thanks for having me on.
Cool. Guys, I highly recommend reach out to Mark. He's a wealth of knowledge and somebody that can help educate you on where you're currently at and help you with your goals. If you want to get a hold of me, you can always do so on Instagram. Follow me on my page is Brandon Elliott Investments. And then our business page is Credit Counsel Elite. So make sure you're following us on there. If you're looking to get up to 500,000 with interest rates as low as 0%, to get up to 90% approval odds, best terms and conditions, and the lowest interest rates, check out creditcounselelite.com. That's Credit Counsel Elite. We have a bunch of good information on there. Happy to jump on a call with you to see where you're currently at, where you're looking to go, and get you a roadmap to be able to get there. And with that being said, if you have not already subscribed to Ready, Set, Go Real Estate Investing Podcast, what are you waiting for? Do that right now, and you'll get the newest notification every single Monday. After listening to a few episodes, leave that 5-star review. Love you guys all so much. We will catch you on the next one. Till then, God bless. And Mark, appreciate you, man. Have a great day, guys.
Thanks, Brandon.
All right, brother. Anything that I could do for you or connect you with anyone? It was a great episode today.
Oh, my pleasure. Yeah, no, good to go. I mean, what's your focus, Brandon? What kind of investments are you offering your folks?
So we focus a lot on ground up construction right now. We've been doing real estate since 2015. So we've done a bunch of things. We're in some syndications as well, but we got rid of a lot of our portfolio on the East Coast, Ohio and New Jersey last year. We just have Arizona and San Diego right now. And we switched over our Airbnb to long-term. We're focusing on ground up construction right now, ADUs. It costs $300 a square foot to build, and it's worth $900 a square foot after. So it's been awesome.
It's great.
It's just time, it takes forever. And outside of that, our business is Credit Counsel Elite. We teach people how to get funding. I used credit cards initially, 0% interest stuff, to be able to get started in real estate. And awesome. I've done private money lending, hard money lending. I've done the BRRRR strategy a lot, all with credit cards, get enough points for vacation, get protection with contractors, and been able to grow the portfolio that way. That's awesome. And what do you're going to keep doing some of that same ADU builds for the next couple of years? What's your outlook looking like? So we're getting done a project in the next month and a half. And then I have another, that's 3 units we're building. We're about to get permits approved to build in 2 weeks to build 4 units in another location down the street. So those are the 2 that we're focusing on right now. After that, I might be selling a couple properties, because I ended up over leveraging. I had basically a kind of a crooked loan officer that had appraisers in their pocket. It was 2007 again, basically, that they were able to get some high, wild appraisals that, I was excited, pulled out extra money. And then I realized oh shit, my mortgage is $14,000 a month. I got a lot of money out, which is cool, put it to work, but the most it can rent out for is $7. Yeah. So, and when I was doing Airbnb, we've had months that we made 30. But when Airbnb, because the market's not working anymore, then it's it's kind of crazy. So, got it. Yeah, hang in there, man. It's all part of being young, I guess, unfortunately. Yeah, it was a great learning curve. It sucks, but it's it's luckily we have our other businesses and other investments that bring in enough money to pay for things, but I don't want to pay, $100,000 for somebody to live in my house. Yeah, exactly. No thanks. Anything that I could do for you though, or connect you with someone?
I mean, at this point, we have pretty good deal flow, but if you know any mobile home park operators that, that'll be a great introduction.
Yeah.
If you have investors looking for passive income, there's ways for you and I to do stuff together and participate and partner. But I mean, that's kind of what I got on my end as far as opportunities. It's usually deals or money, right, in this space.
Yeah. The last ground up construction we did too was like 800,000 to build. And I stupidly didn't take out a loan for it. So I was just paying out of pocket. And I realized like how dumb that was. And just because it put such a crunch on my money. But luckily we're at the tail end.
Oh, good.
Yeah. And so we were able to get through it all. And now when I refi, I'm not going to take out more than what it will cash flow.
Yeah. Smart.
Yeah.
There you go.
Yeah.
Good.
Well, thanks,
yeah,
dude.
Cover that base.
Yeah. Yeah. Well, I appreciate you.
Likewise.
Yeah. If you need anything, let me know. Okay.
All right. Thanks, Brandon.
All right. God bless. Bye.
Talk to you. Bye.
This has been another episode of Ready, Set, Go Real Estate Investing Podcast, brought to you by Brandon Elliott. For more information, please visit BrandonElliottInvestments.com. Also, please don't forget to like, share, and leave a comment below. Thanks again for joining.